What's up, guys? Welcome to another Trade Genius podcast. Philip here with Bob on location. We're going to talk about a signal that 100% will tell us when the recession is going to start. It actually comes from the Fed itself. You're not going to want to miss this, so let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
So, Bob, as we're going through all the different data points, it's funny what we find that gives us really good signals. And, you and I are both macro bearish on the second half of the year. And I think the one thing that's going to set this off and where you're going to want to run for the hills as far as your portfolio goes is what we're going to show these guys in this chart with the triple B rated corporate bond spread versus the 10-year Treasury. I know it's a mouthful, but we've shown you guys the 2-year and the 10-year. This is the triple B rated corporate bonds versus the 10-year. This is the spread between them. And you can see the red sections are the last 3 recessions that we've had. 2020, the last one, very brief because of the Fed intervention. But as soon as this starts to spike up, this is when the recession starts, and actually a little bit before then. And so we're diving down right now. Bob, I'm going to kick it back to you because as we go down here, I think that tells us the corporate bond market is in demand still. And I think the Fed is actually looking at this to guide them whether or not they need to pivot.
Yeah, I think what's happening now is that there's such a thirst for yield, even fixed rate yield that's higher than what they've been getting here. And so it's basically been doing the work for the Fed. So basically Powell still has runway here to keep increasing. In fact, you heard the guys today talking, Bullard and those guys saying, hey, we can keep pushing interest rates higher because Powell needs to see that he's going to break this market in terms of the appetite for growth through leverage.
Right.
And he's not going to stop until he gets something blowing out. What we had here with the banks wasn't basically a failure of the banks. It was a duration failure, which they basically fixed in literally 2 weeks. And all of a sudden, everybody got the liquidity nerve again, and they've been trying to leverage economic growth again. And what they don't see coming at them, Phil, is $330 billion of refis coming at them. And so you're going to get a reset here, and that's going to start blowing out the triple Bs. And what I mean by A paper, B paper, C paper is A paper is like, McDonald's and the Fed. B paper are good companies, but they don't get the best rate. And C rated paper is speculative. And then you get down into junk. So yeah, I think you got to watch these things. And look, things aren't going great anyway. The market has basically been stalled out here. All we've been doing is playing this game of ring around the rosy around this range. And I think maybe Phil, you should show that one chart where basically the market goes up until it gets too many over the moving average, and then it drops back down until it gets hardly anybody over the moving average, and it goes back up again. And basically, it's just the algos are basically playing frisbee with each other. No range has been breaking, except now, we've been getting word in the tech sector, they basically pushed off Armageddon until the second and third quarter earnings reports. They promised that growth is coming back, and they pushed off the dire warnings, and they laid people off, but growth isn't coming back, Phil.
Right.
So like phase 1 is with BlackRock, where the duration risk have people gated now in terms of they can't get their money out of these real estate funds. And the second phase of this is when people can't get out of their fixed income funds. And that's when you can start seeing the blowout, Phil. And that's the issue here. When they're going to have to refinance $330 billion money going from 1% to 5% to 6% to 10%. That's going to cause a lot of stress in the markets. And that's the thing that people just got to keep watching out for. Take advantage of any lift in the market to raise more cash or to move up what they call the risk ladder term safety wise. And like I said, second half of the year is going to be awful. These big tech companies have thrown everything they could at the analysts to keep this show on the road, and it's ending. We hear it, in our, basically the whispers that we're getting is a lot of these guys are out of their tricks, and you got to be really, really careful. And the breadth is awful. We're talking, 88% of the market's moving with 12% of the stocks. That's even blown away the 80-20 rule. We're really getting to a point where we're really trying to thread a needle here to keep the indexes up.
Agreed. And yeah, actually the NASDAQ breadth actually crossed back down on our little signal line. And so it just had finished crossing up, which provided a bounce in the market, but it's actually gotten really weak in the last day or so, and is telling us that tech looks more risk off than actual S&P 500 on a relative basis. So tech might drag us down actually, but there is a lot of momentum. There's still a lot of liquidity in the system. So there's some cross currents here. And then we're going into the holiday, so we might have some tailwinds into that. The spread here is important though on the triple B rated, because making corporate debt cheap. Fed's on the mission to make the credit situation tight. And like Bob said, when they see this start to turn up, they'll pause, but it's not going to be the pause or the pivot that you want, because it's going to be because they have to, because the economy's cracking, the markets will be down. And that's what's always funny, is because people are cheering for a pause or a pivot, but that almost never is in a good way. It's always usually because we're going to go into a recession. So there's this period of, ultimately it's nice because there's going to be some accommodation, but everyone forgets about the pain that happens before you bounce and start going back up. So I think this is key. I think this is going to definitely be the thing that signals it, and we're going to keep tabs on this graph going forward for you guys, because as soon as that thing starts to kick up, that's when you probably can number the amount of days that we have as far as this market being able to seemingly defy gravity as it's been doing the last couple of weeks, and since the first of the year really. So
yeah, it's a pivot from hell coming. And just remember, guys, when we come out of this earnings season, we're gonna run smack dab in the middle of the budget fight. And I think the political parties are in no mood for compromise. And so, and that's going to be really interesting, because that'll actually slow down economic growth even further. So the season coming is not bullish.
Not at all. Yeah, in fact, McCarthy even said last night that it's not going to be just a simple raising of the debt limit. There's going to have to be some structural changes to the approach. So it's going to be way more of a fight than it was, I think, last year when they addressed this, for sure. So, and then we got earnings next week too, Bob. Probably not going to be pretty.
Strap in, everybody. It's going to be a wild ride. But volatility is our friend. So, stay tuned, listen to us, and we'll hopefully be able to thread the needle for you guys.
All right, cool. Well, Bob, I hope you're enjoying your trip. Guys, we'll see you on tomorrow's video. Thanks a lot for watching. Please hit like and subscribe, and we'll see you on the next one. Take care.
Trade